Kitco News special coverage of the Bank of Montreal's 32nd Global Metals, Mining, and Critical Minerals Conference is brought to you by First Majestic Silver.
We are back at the Bank of Montreal's Global Metals, Mining, and Critical Minerals Conference in Hollywood, Florida, and back with E.B. Tucker, editor of the Tucker Letter. All right, good to have you back.
I'm still glad to be here.
We covered a lot of ground in the first part of this interview. Second part of this interview, I want to start off with a line from your book where you write, "The first quarter of 2020 marked the end of capitalism as we know it. That's what the history books will say." The end of capitalism in 2020. That is a very big statement, E.B.
It is, and I'm really impressed that you read the book and caught that, because a lot of people glossed right over it. I went on to tell some stories about my upbringing. My grandfather was in banking and taught me about the price of interest, and I knew all these interesting people in the banking business. And the best story in the book with that respect is the CEO of a bank in the state where I came from said to the federal regulator, "Why don't we fix the price of oranges?" And the regulator told him because it would incentivize poor orange quality in the crop. And this is America, and it's a free market. We would never do that. And his answer was, "Then why do you fix the cost of interest?" And the guy became very irritated. So we're in a scenario where interest expenses are not set by people with savings. Like, you don't decide how much you get for your savings. And it's decided by a committee of people. And really that committee is very complicated. It's not what you would think, like it's not a democratic vote. It's a very complicated scenario because the committee's real job is to maintain the power and the strength of the dollar so that you can run around the world and club people with sanctions, which you can't do if the dollar is plummeting in value and is not being used in trade. So you have this really complicated job. And so it's a centrally planned system. And what we saw in the pandemic was this radical shift in central planning. Things started happening really, really fast. And no longer was going into a recession, making a few adjustments. It was, do you remember the junk bond market literally stopped working? And then the Fed said, we're gonna buy junk bonds starting now, today, and the junk bond shot up like crazy. Howard Marks, who's one of the most famous investors, all investors respect Howard Marks, came out and said that it was very frustrating because they didn't even have time to raise a fund to take advantage of the crazy junk bond, right? So the market can't work. The market should fix these problems. The market can't work, and we took that into hyperdrive during the pandemic, and now we're a long way from buyers and sellers determining the price.
So we've had Fed and government intervention before, but you're saying that 2020, it just went
next
hypercharged.
level. And you never really have had that type of behavior with the administering cash to people. And now, you remember when I wrote that, it was April of 2020.
Yeah, still early in the game.
Really early.
And we saw how that played out.
We didn't know that you were going to take those STEMI checks, and you were going to sit at home and vape and gamble on stocks on Robinhood. And you might not even know what Robinhood was. And nobody knew what the consequences of all of this would be. You created this radical shift where you couldn't get a bicycle, but then there was too many bicycles. And then so all these things
So the free
happened.
market forces got thrown way out of whack with the extreme
and it's
government
even
intervention
happening now.
by non-elected officials, as the Fed is.
That's right. It's once you learn about the Fed, it's not a conspiracy. They have an obvious job. In fact, it would be a bit crazy to not have them when you start really looking at the mechanics, because you would have a difficult time maintaining power as a world central power. It would be very hard. And when you get power, you don't want to lose it. I mean, that's why the politicians say, I'm going to go for one term, and they stay there until they're wheeled out on a gurney, right? They their whole life. That's the trend in power, is that you go more, and there's kind of no limit to what you'll grab onto. You lose perspective. And so that's where we are.
Yeah, definitely an advocate for term limits. And I see your point that the natural cycle of supply and demand got shot out of whack.
Yeah, it's gone.
Is it the end of capitalism? Is a big statement, but definitely
it's a big statement.
Definitely
it's a big statement, but someone
dent into the system for
but
sure.
someone needs The reason why big statements are important is because someone needs to ask that question. And in my personal life, my friends know that I'm always encouraging them to play out their thoughts to an extreme. And the reason why is because when you play out your thoughts, like you want more money. Okay, what if you had all the money? What would you do? And then you say, I don't know, I never thought of it. So you need to play these things out to an extreme, and asking a big question, I think, is a way for centuries people have used writing to ask these big questions to make you think about that extreme. Yeah. And I think it's really hard to advocate now. I mean, look at the US economy. 20% is housing, okay? 20% is medical services. I would say probably 40% is some form of government. And then maybe, 10% like insurance. You get down to where you have only, you grew up thinking in the US, I'll have a business. Your parents say, make a lemonade stand, learn about business. That's such a tiny, tiny portion of the economy now. It's almost non-existent. I mean, I'm trying to encourage my kids either to be artists or something fun, or a politician, because I mean, it's like the whole economy now. I mean, if you visit central states, I'm sure you've been to some places that were formerly communist states, they have rings around the city. And whatever ring you live in signifies your connection to the central power. So if you had an apartment in the smallest ring in Moscow, you were very close to the power. And if you were way out in the last ring, then you're a factory worker. So it's interesting to see this now, is that it's very hard to advise young people to go into this like spirited entrepreneurial activity, because when you really look at the facts, it actually does not make a whole lot of sense.
Yeah, very hard to get Gen Z to do anything that doesn't involve posting TikTok videos, but so I hear.
I love TikTok. Yeah, I've never been on TikTok, but all the time now, because I don't have my phone, so I'm watching where I'm going. I'm having to move because people are filming themselves. Yeah. And I'll ask them, I say, I'm just curious. I know I'm an old guy and I don't know what's going on. What are you doing? And they'll explain to me that they're dancing on a video to post on the web. And I ask them, are you getting paid? No. And I think, what is the point? Why don't you go to a dance club? Then you would meet people. But they don't do that. That's what we did, is we go to a club where everyone's dancing or something. You want to dance, you go to a dance club. It doesn't happen anymore. Like now, my friend was saying, as kids, when we were kids, you'd know where everyone is because all the bicycles are in the person's yard. Yes. Okay, remember this? But now you have no idea where people are. They're just online.
Right. Well, that's a whole other conversation about the scourge of social media, the balance of the pros and cons there. But again, I
just think people should have 1 3 or 4 hour period per week with no advice. Phone, only because it is very fun. Believe me, you notice things that you never see when you're looking at your...
That is definitely sound advice. You offer a lot of sound advice in your newsletter. I want to discuss one of the things that you wrote in the latest edition of your Substack, where you write that we are in for 14 months of pain. Yeah. Where do you get 14 months from? Why 14?
Okay, so in fairness, if they go to ebtucker.com, they can read this, where I do break down how I get to the 14 months. But essentially, the Fed wants to take the balance sheet back to pre-pandemic levels, and based on the rate at which they're shrinking the balance sheet, in order to get there, it would be somewhere between 14 and 18. We kind of break down the mechanics, and we don't really know if they'll keep the pace or up or down. But I explained that they actually have just gotten started. And the whole nature of the article is my friend who is involved in the mortgage business is having a really lean year, and he's very frustrated. And so he was telling me this, and I was just asking him kind of, how are you feeling? What's going on? And as he tells me things, I'm relaying them in the letter, and I'm trying to say to him that, you have to be ready for more. He thinks it's going to turn around. He's like, well, the Fed's surely going to fix the interest rate back to where people take mortgages. And someday, but probably not immediately. So you have to be ready. I mean, Jerome Powell said at the Economic Club in Washington, with David Rubenstein, who was his former boss, which is amazing, that he's going to take the balance sheet back to this level. And I try to encourage people to understand the Fed usually tells you what they're going to do, but you don't listen. Like Bernanke told us that he was going to do QE because it was going to make housing prices steadily rise. and it was going to make your 401k steadily rise, and everybody would be happy. And all the gold people said, no way, but it actually worked. And so he told us what he was going to do, and he did it.
Are you surprised that the Fed has been this aggressive? Because
absolutely.
In previous interviews, you said the Fed isn't going to taper.
I never thought they'd do it. And I think the reason why they've done it is because a year ago, when all this happened in the East, the dollar, I think, came under major pressure that maybe we don't even know about. And the radical
So this
shift,
is about protecting the integrity of the dollar.
I think it's, I'm not going to say it's in trouble because I do not believe in a dollar collapse. I think that it's more likely that it needs to be defended. It needs to be strengthened up a bit. It needs some TLC because otherwise they went a little overboard with the sanctions. I think it's easy to see that they pushed it too far. People have had enough of the sanctions. They're very frustrated and they don't think that it's fair and just anymore because you got to remember, the US is the majority controller of the World Bank and IMF structure, right? So the US is running around the world using debt as a tool to control people. I mean, they're like 80% of the voting. I'm not exactly sure the number. You can look this up. But the rest of the world has no say. I mean, like absolutely, it's like having super voting stock in Google or something where Sergey controls the whole thing. You don't do anything. You just own the stock, but it's not the same. And the world is frustrated with this and pushing back. And the question is, I don't have an answer, but the question is, has the US pushed it a little far and now they have to rein it in? And I love when people say to me, I've been at a dinner party, somebody said, yeah, well, you said the Fed would never raise rates. I said, look, it's a centrally planned system. They don't call me before they do it. So, I mean, when I looked at this debt pile, I thought to myself, there's no way that they can jack this thing up. And they went fast because if they went slow, it would be worse.
But you're saying because, as we discussed in the first part of this interview, the dollar is being threatened by a bifurcation in the global monetary system.
It's obvious.
With the East potentially coming up with their own currency, as we've discussed before, the BRICS coming up with a different reserve currency, potentially backed by commodities, that in order to restore faith in the dollar, which is backed by nothing but the full faith of the American government, the Fed has to be this aggressive to show the world that it's got things under control and that holding dollars means something because they're not going to go ahead with MMT, even though they kind of already did. So they have.
Well, I mean, they went too far because you look down and there's books about the lending to control. This became a thing like in maybe the 50s and 60s was like let's use lending around the world as a way to control other societies. And you can go back and see how this became a thing. And you can't do that if your currency has readily available alternatives that are better, right? So I think they reached a point where, like think about the whole Russia sanctions thing. They can still sell oil and they can sell it to the Indians who then, do some refining and sell it. It's crazy. I mean, it shows you that we'll know when we're older. There'll be books written about what was happening really at the State Department last year, and we'll probably see that there was a lot of very heavy pressure on the system that we knew for 35 years or so. I think it's evolving, and people need to see that as that changes, there will be investment implications.
Okay, so given that you think that the Fed will maintain this aggressive course because it has to, let's expand on just how high you think it'll go, because Wall Street is now pricing in 6%. It's gone out from 5.1 to 6% as a terminal rate.
Well, I mean, based on the fact that it's centrally planned, it's very difficult to know. But
you're not in those meetings.
Yeah, I don't think they want me in those meetings. But the thing is that when I look at a chart of the 10-year, like I was telling in the newsletter, I was telling my friend, the 10-year really could go to 7. And people say, what, 7? It's like, look, I'm telling you that if you look at this chart, it really could. I mean, it went down for 35 years or something. I mean, it could definitely shoot up now. Because remember, it went up and it's kind of calmed down. And now it's deciding what it wants to do. And the thing that's so crazy is that the US has so much debt that as they're rolling these over, I mean, I have a Treasury account to bid in the Treasury auction. The 6-month bill is 5%. 5%. I mean, it's really crazy. I mean, it's a lot of money, right? $1 million, that's $50,000 a year in Treasury bills. I mean, that's it's a high interest rate from what we've been used to. And so as this debt begins to roll over, what's going to happen is the cost to service this debt is going to rise much more than they expected in the budget talks. And we're going to go to Minnesota and talk to this congressman, of course. We'll ask him about this. But I think this is going to create, extreme pressure. And the Fed, I want you to picture the Fed in a really difficult spot. Do we keep protecting the dollar so that we have the ability to go around the world and control everyone? Or do we switch and protect the home system? Okay. In which case we're going to unleash rapid and dangerous inflation. It's not going to be like the 70s. It's going to be very different. And I think they're faced with this dilemma. And that's why they've gone so fast, is because if you go fast, as debt is rolling over, you have more time if you go fast. If you went slowly, then as debt rolls over, if you went 2 years, most of the Fed's debt rolls over, like the Treasury debt. So because most of it is on the front end. So, and companies, remember, there's companies that borrowed and they borrowed for 0% or 2% or whatever. They're not making any money. They don't have to turn that over until next year. Right. So they're still thinking, the Fed will come back down. So
the Fed will be aggressive. And of course, that's going to be a problem for the economy in terms of bringing in in a recession. And you say that you expect stocks to fall between 15 and 20% before summer.
That's right.
That's in the next 3 months.
It's already happening right now. And I explained
We're talking across the S&P 500. You're anticipating a 15 to 20% drop from where we are.
And I think it's already happening. I show in this week's letter how it's happening right now, and explain what I'm seeing in the market, the attitude I'm seeing. I see people complacent. They're waiting. They still have the energy to gamble and to risk on things and to buy risky stocks, and all these. They're not afraid. And when people are not afraid and the chart is doing this, it tells me that the chart is going to do this. And I think that's going to be quick. I'm not sure you need to trade that. I mean, I don't recommend in the letter going short. It's not that kind of thing. I think once you see it and you start looking around the people and your daily life, I think you see like this could definitely get ugly.
Yeah.
Quickly.
So I mean, a 15 to 20% drop in the next 3 months, that's pretty ugly.
Ask people how much cash they have. I do this at dinner parties. It's very inappropriate, but I say to people, what do you think? How much cash do you have? Most people do not have much cash at all. And I don't mean dollars. I mean, if you have a portfolio, what percentage of that is in Treasury bills? And usually people say none.
Should it be in cash?
Well, I don't give financial advice, but I personally myself don't like I like to have the cash I need around for a certain set period of time. If I have I'm about to pay the largest tax bill of my life. It's very strange, but I don't want to be going for the money for that a week before. Does that make sense? I want to have some buffer, cash around to pay for things that I need to pay for. And so my philosophy is kind of like, you don't want to be put into Buffett said this in his letter. He said, we're not going to be put into some position, where we need, because he was saying do something with the cash. He's like, well, we will, but we don't want to need money and then have to go sell something in a bad market. It's the same thing that you're hearing here.
What would you suggest would be the way to anticipate this 15 to 20% drop?
So what I always remind people of is like, there's a company, United Rentals, for example. I was looking at the stock recently, $400 and something stock. 2009 at the low, stock was $3. $3. So it's up like 125 times or something. And what I always ask people is that if your stock went down 90, I'm not saying it's going to go down, but I'm saying when stocks went down to this unbelievable level, did you buy them or did you not buy them? And people always say, no. Why? I didn't have any money.
So keep cash on the sidelines.
And so the thing is it really going to hurt you if you have a Treasury bill that's paying 5%, it might be paying more soon, maybe 6%, sitting there, and if something does happen, then you have the ability to go shopping. Because I don't see people selling. Remember how you can't get a watch, you can't get a car, I don't see people selling things yet, and I think they're gonna need to sell things. And when they start selling things, you're gonna realize there's not as much of a bid there as they thought. And then when they do that, the bottom goes out quickly. And I think it will turn. But my point is that do you really want to ride that roller coaster, or do you want to sit off to the side? I would rather sit
on the side, have some dry powder ready to go to take advantage of the sale. Yeah, we have several guests on the show that echo that sentiment.
Yeah.
I want to ask you about the potential of what we're seeing in terms of synchronized central banks raising interest rates and where the opportunities are if around the world they seem to be following the same path. We had the Bank for International Settlements recently warning that the markets should not rule out a global synchronized reversion to higher than expected rate levels. The head of the Monetary and Economic Department at the BIS, Bank of International Settlements, Claudio Borio, saying central banks have been very clear about the priority of getting the job done and of being cautious about declaring victory too early. To ensure that high inflation is brought under control, central banks will remain hawkish for longer than expected. It's important for central banks to avoid repeating the mistakes of the 1970s by not declaring victory too early.
Well, I don't know Claudio, but it's a wonderful statement.
But what do you make of that? I mean, what does that signal to somebody such as yourself who's aware and observes history? What should we make of that?
Well, I mean,
globalized,
obviously,
synchronized central bank action.
In part one of this excellent interview, you mentioned the truckers, and I always point out to people that regardless of what you think about the truckers in Canada, the people, Foxconn people in China, every time people finally said we have had enough, is when the governments back down, right? And that's what's going to happen with these rising rates. I don't see any. I'm trying to get it done a reservation tonight in Fort Lauderdale. Can't do it. I don't see any pain at the moment. I know some people are in pain. My mortgage buddy's in pain, but I don't see broad pain anywhere at the moment. Okay, people seem very happy. They think the Fed's going to turn around. Blah blah blah. All the job cuts. People have severance. Nobody cares. And so when you see that pain, that's when they stop, because people will revolt to a degree. I mean, I don't think we revolt the way we used to, but they will become very upset and they will start not participating and there'll be some tension, and then that's when you'll see it stop. And it's not here yet. I mean, airport flights are full. Everything is full. You can't, I'm having a deck done with Brazilian Ipe wood, which I've just learned about. It's very interesting. And the guys say, I can't get it. You know, but when you see these things starting to roll over, then you know that the turning point is coming. So you have to watch for that. I think you have to always be, you have to see that.
And that you think is going to happen over the next 14 months, to go back to
definitely. I don't think they'll make it to 14 months. I really don't. I was at a great investment conference in Charleston, South Carolina last week, and I was asking a panel if they thought this would work. And everybody's agreement was there's no way they get to 14 months, because when this thing starts to rattle, I mean, in the book, I say it's like blowing up a balloon. Yeah. You can't go smaller. You go a little, you blow up 100%, you go down 10%, you really feel it. And so that's what's going to start happening. And then when people have low tolerance for pain, they have very, 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 very low tolerance now for recession.
In this 15 to 20% sell-off that you're anticipating by the summer, which equities are better to have than others?
So you have a rotation of leadership. You know, you have everyone still believes that tech is the best thing that you can own. I'm not going to say if it is or isn't, but I want to say something that tech had an unbelievable, once-in-a-lifetime, worldwide rally in U.S. tech stocks for the last, say, 13 years, roughly 12 years maybe. And when you exert that kind of energy in a market, it has to cool off. It's kind of like real estate. Real estate has had an epic run, which we write about this week in the letter, for the last 12 years. It has to cool off. And so when I'm looking at things that I want to own, one thing that attracts me to the carbon business, and the carbon business is performing exactly opposite of these markets that are in trouble. The carbon price keeps going up. I want to have some exposure to things that did not participate last time. And it's not just because I want to be different. It's because stocks, people need to understand, and we're going to talk about this next month, is in the letter, is that stocks are like a psychological checkup of everybody that's participating, and you can see their emotions in the stock chart. And that's when you look at a stock chart, what you're looking for. And so you can spot when it's become too lofty and too low. And I think right now, too low maybe goes lower, but then flies back. And it's not owned, and there's no participation.
Before we get into carbon credits and the carbon market, I want to get your thoughts on gold and silver royalty companies, because you are the director of Metalla. Is that a good place to be?
Well, there are other directors. I'm not just the director.
Yeah.
I mean, I'm an independent. I'm always fascinated because I was always, when I was owning my first stocks, I was reading the annual report and voting. Okay, and so I always knew about corporate structure. My grandfather was on a board. He taught me all about this. I'm always shocked how people don't understand what a director is. I'm elected by the shareholders to be on the board. I don't work for the company. So I get these like messages from people. I'm like, you do realize that I'm not the CEO, right? Well, yeah, you are. No, I'm not. I'm a director. They go, same thing. It's not the same thing. My job is to represent the shareholders. So the reason I like Metalla is because Metalla has something that I think is really, really valuable, and it's the ability to be unbelievably patient. Metalla has 5 employees, 80-something royalties, and very little overhead. They have a very small office in Vancouver. It's almost 1,000 square feet. It's nothing. And they can just wait. And the royalties don't go away. They are forever. They go for the whole land package. And the companies, a lot of the companies that are here that are run by famous, I'm sure you've interviewed some of these people, the famous mining company executives, they don't have that ability. They have to continue digging. They have to go right through the down market. They have to finance. They have to meet ESG mandates. They have to change their trucks to electric. It's really tough. And Metalla doesn't do any of that. And if Chile raises the copper tax, then you have a copper royalty, for example, then you get a higher, your copper that you get is worth more. I mean, so you have this insurance against.
Well, I get that you're not the CEO of Metalla, but I do want to ask you about the company's performance, because the share price is down 35% over the past year.
Yeah,
and by contrast, the physical gold spot price is only down around 5%, and the gold ETF is down 4.5%.
I have 2 things to say about that. The first thing is I bought a lot of stock in that company, and I'm happy that I own it, but the rest of the board would vouch that I've been the least enjoyable board member the last 6 months because as a financial investor, in addition to my board role, those are kind of 2 separate things, it's been very painful. And to be totally clear with you, I'm not sure that there's a lot the company could have done. I mean, the rest of the royalty companies don't look very good either. And what I think people should know about that is that a royalty company has a leverage to the gold price both ways. And if the gold price shoots higher, then the value of the royalties by default is higher because it extends for many, many decades. And if the gold price is not in a good place, it shot high during the Russian invasion last year, and then it came off maybe $400. It was quite dramatic, the gold price. And that was a year where the interest from fund managers, the interest from investors in gold royalty companies was really low. And so I have been quite discouraged. However, I will say that the thing I like is that I want to have this asymmetric, patient bet on something that I think is a matter of when, not if. And if I can get that bet cheap, I'm very happy to wait on that bet, because unlike an option which expires, that bet is gonna sit there.
And your bet is for gold to be at what price in the next 5 years? Price range?
Well, that's a long time, and it definitely puts me in. It makes a piñata out of me. But I will say, let's first start with the gold price hitting its base this year and shooting over 2,000, and then let's reevaluate, because this conference right now, you might not know this, I've been in a lot of meetings here, is that people they don't have money. The fund managers say, okay, I used to have a $500 million fund, I now have a $200 million fund. So by default, I want to hear what you're up to. I want to get an update on the company because I have a position, but it used to be a bigger position. If the gold price turns, then that fund manager gets a call from a pension fund that says, I need to put more money into the fund. And then he turns around and buys all the stocks that were in that fund. So when that happens, the thing blows up like a balloon. And I think it's important for people to see that's what you're waiting for. It's the same as if someone invests in cybersecurity ETF, boom, all those companies that are in the ETF go up by default. And so we haven't had that. We absolutely, and so let's see that first move, and let's see what there's been 9 acquisitions in the royalty business, 9 takeovers. And there's nobody. Mavericks, once they went out, there's nobody left. So how is it that 9 companies were bought and the industry is shrinking, no new companies are starting? It's been a very tough market. That said, you want to get involved in markets that have a great future but have had a bad year. And from what you just read, which is all factual, fits the case to me.
Okay, so it can only go up, or a good time to get in is when something is down. Let's not say it can only go up,
I don't want to say
it
can only go up, because I believe that if the market sells off, it's very hard for stocks to go up.
But buy low, sell high, and now is a good time to buy.
Personally, I don't borrow to buy. I don't like trade on margin. Okay, this is one of my things. I'm going to write a book about EB's secrets to a long, prosperous life, and one of them is I don't borrow money to buy stock. And it gives you a lot more patience.
Yeah. Okay. Buy low, sell high, that old adage. One market that you are very optimistic on as well, and very quickly want to tell our viewers about it, is the voluntary carbon credit market.
Yeah. We're doing it differently from people. We've got a private company, Carbon Neutral Royalty. So what we figured out was that the offset needs, and what that means is that, let's say a company like BP or someone measures their carbon footprint, and they have to essentially do something to lower that and also to abate that, meaning, they can't lower it to zero. It's very difficult. They can get it down, but not all the way. And so what are they going to do to fix what they're doing on through the smokestack to the economy and to the world that we live in? And so what we figured out was that this market was quite interesting because it was a lot like the royalty business that we're already in. You had to find the best projects in the world. And so we found those. And we were able to secure the right to fund those. And in return, we get credits, which we can sell in the exchange, just like when you have a gold royalty and you get the ounces of gold, except for this is a new market. So it'd be like
it's like buying a license to pollute in a way if you buy carbon credits, or it helps to offset.
Sort of. You'd be surprised. I just came from the North American.
License to pollute is an extreme statement. I'm hanging around you too long. I'm not making extreme statements. But
it's okay. The good thing about the extreme statement is then you get to
walk it back.
You get to color it in and make it right. So I just came from the North American Sustainability Summit, where Boeing and 3M and all the companies were there. And what you're figuring out is that the companies are determining their emissions based on scope 1, scope 2, scope 3, and then they have a plan. And then the credits fit into that plan. Right. So you're not going to be allowed to just recklessly pollute and buy. It doesn't work that way. So as you go through those phases, the voluntary market becomes a way that you say to the regulators, this is what I'm doing, and this is my abatement program. And what we figured out was that ESG is not just environmental. I mean, I love Florida. The governor I've seen him in person, very close. He's a really good guy. He should say ESG is not just the environment. I mean, there's social, there's governance, there's a lot of things going on. And the thing about the credits is that you have a tremendous impact on the communities that you're involved in. And we're finding that the companies want to say, this is what's really happening, and it's a part of their plan.
So, EB, how does a retail investor get exposure to this market?
Well, okay, so we've not taken this public yet. The reason why we've not taken this public is because the company is growing far bigger than we originally anticipated. In fact, we may end up being the largest, voluntary market royalty company out there. It's a little early for that statement, but we're kind of neck and neck with being a leader in that market. And so when we list this, we want this to be ready for people to be able to participate. And I will be telling people when this happens, of course. But Metalla, Nova, we had a history here of building a certain type of company. This company is going to be quite a bit larger than those companies. But I anticipate this being the purest way to participate in the nature-based portion. It's important because some people make machines that is nature-based. Think mangroves, which is the most powerful way to capture carbon. We're planting 8 million mangroves in the last year. So we're going to plant, many, many millions more. It's really remarkable. And so Bill Gates wrote about mangroves in his climate book. This is really interesting stuff. But investors will be able to see, understand, and see the track record of what we've done in the other businesses. It's very stable, and then get involved. It's coming.
But beyond your company, if a retail investor wants to get in before you guys list, what are the options?
You know, I was at dinner with a guy that's a railroad executive this weekend. He was asking me, can he buy offsets and flip them in the market himself? The answer is actually yes. I'm not sure it's a great idea because these credits are very unique to the place where they're certified. And then the companies, when we're selling them to the big companies in the world that I mentioned earlier, they want very specific exposure. So the credits do trade, and you absolutely can get involved in that market. It's becoming a more organized market. I'm just not sure that it's the smartest thing to do because unlike gold or something that you can melt down, the credit is unique to the place where it was made. And you're finding that credits from the Kyoto era are not worth as much as credits from the Paris Accord regiment. And as this evolves, I think that a company is going to probably be a more effective way to be involved than.
All right, we'll have to wait
it's
until.
Coming. I mean, it's coming like a freight train. Believe me, you can hear it coming. It's coming. It's going to be really, really exciting, and we'll let people know.
All right. Well, E.B., thank you so much for breaking down so many different concepts and issues with us today. Really appreciate it. E.B. Tucker, and again, the Substack.
ebtucker.com. So if people go to ebtucker.com, they can sign up, they can read for free. Right now, I'm trying to get people up to speed. I've been off for a couple of years, wrote a book, did all these things, started a carbon company, trying to get people back up into the driver's seat with me and come along, have a journey with me. I promise you'll be entertained, you'll have some fun. And I hope you'll follow me there at ebtucker.com. It's very easy. You can go there right now, sign up today. The next issue is Thursday. It's every other Thursday. So I don't bother you with notes or advertisements. It's just me to you every other Thursday.
Well, I've been entertained in this interview, so thank you so much, E.B. Tucker. And thank you for watching. I'm Michelle McCory. Keep it right here on Kitco News.
Kitco News coverage of the 32nd Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver.